The average London home now costs over £540,000, but experts are quietly predicting a crash that could wipe out 20 to 30% of that value by 2026. While headlines celebrate stabilizing markets and gradual price increases, a perfect storm of warning signals is building beneath the surface, signals that mirror exactly what happened before the 2008 financial crisis. Mortgage rates that briefly touched 7% have tempted buyers back with modest decreases, but a dangerous cycle of debt is reaching its breaking point. In central London, luxury properties are selling at 40% below their 2015 peak, while foreign investors are quietly exiting the market at an alarming rate. Meanwhile, a controversial but remarkably accurate economic theory called the 18-year property cycle has predicted every major property crash for 2 centuries, and it's now pointing directly to 2026 as the year London's housing bubble finally bursts. The most shocking part isn't that a crash is coming, it's how many sophisticated investors already know and are quietly preparing, while everyday homeowners remain completely in the dark. The warning signs are hiding in plain sight, and what you're about to learn could save you from financial disaster. When economist Fred Harrison published his book Boom Bust in 2005 predicting a housing market crash in 2008, he was laughed at by mainstream economists. 3 years later, as property values plummeted and the global financial system teetered on the edge of collapse, nobody was laughing anymore. Harrison's work wasn't based on complex algorithms or insider information. It was founded on a simple but startling pattern he'd identified. Property markets follow an 18-year cycle of boom and bust that has repeated with eerie consistency for over 2 centuries. The pattern is remarkably consistent, approximately 14 years of growth, including a mid-cycle dip, followed by 4 years of decline. Looking back through history, the evidence is compelling. Major property crashes occurred in 1989 to 1993. Then again in 2008 to 2012, precisely 18 years apart. Go back another 18 years to 1971 to 1973, and you find another significant market correction. This pattern stretches back to the early 1800s with remarkable consistency. What makes Harrison's theory so powerful is that it correctly predicted not just the 2008 crash, but also the resilience of the market in the post-pandemic era when many were calling for an immediate collapse. While mainstream analysts expected property values to plummet during COVID-19, Harrison's cycle suggested the market would hold firm until the next cyclical peak. Now, Harrison and other proponents of the 18-year cycle are pointing to 2026 as the year when London property will hit its peak before entering a devastating 4-year decline. Based on the cycle's historical accuracy, this would mean property values rising until late 2026, followed by a market correction that could last until 2030. Critics argue that government intervention, changing interest rates, and unprecedented global events like pandemics make such predictions impossible. Yet the cycle has persisted through world wars, technological revolutions, and dramatic changes in financial systems. What's truly concerning is what the cycle reveals about human behavior. The pattern isn't just about economics, it's about psychology. As each generation forgets the pain of the previous crash, the same mistakes get repeated. Excessive optimism leads to overextension, speculation replaces prudent investment, and debt reaches unsustainable levels. But the 18-year cycle is just one warning sign among many. To understand what's really happening in London's property market, we need to look at the dangerous debt bubble that's been inflating since the last crash, a bubble that's now reaching its breaking point. Beneath London's seemingly stable property market lies a ticking financial time bomb. Hundreds of thousands of mortgages set to reset at dramatically higher rates in the next 12 to 18 months. During the ultra-low interest rate era of 2020 to 2022, London homebuyers locked in mortgage rates as low as 1 to 2%. These historically low rates enabled purchasers to stretch their budgets and take on larger loans than would have been possible in a normal interest rate environment. The average mortgage in London skyrocketed to over £240,000, the highest in the UK and nearly twice the national average. Fast forward to today, and the Bank of England's base rate stands at 4.25%, with the average 5-year fixed mortgage rate hovering around 5%. For homeowners whose fixed terms are expiring, the financial shock is severe and immediate. Let's put this in real terms. A London homeowner who borrowed £500,000 at 1.5% in 2021 would have been paying around £1,900 per month. As their fixed rate expires, that same mortgage at 5% jumps to nearly £2,900 monthly, an additional £1,000 per month or £12,000 annually. This isn't a hypothetical scenario, it's the brutal reality facing over 200,000 London homeowners by the end of 2026. Industry data shows that approximately 70% of all UK mortgages taken out in 2021 to 2022 were on 2 to 3 year fixed terms, creating a concentrated wave of refinancing that's about to break. What makes this particularly dangerous is the combination of higher rates with inflation's impact on other household expenses. Energy bills, food costs, and transportation have all risen dramatically, shrinking the financial cushion families might once have had. Even high-earning professional households are finding themselves stretched to breaking point. The numbers tell a sobering story. According to UK Finance, the percentage of London homeowners spending more than 40% of their income on mortgage payments has already doubled since 2020. That's before the bulk of these fixed-rate deals expire. Most concerning of all is that many homeowners took on these large mortgages at the absolute peak of the market. If forced to sell in a declining market, they face the prospect of negative equity, owing more on their mortgage than their property is worth. Banks are quietly preparing for this wave of financial stress. Internal risk assessments at major UK lenders project mortgage delinquencies to rise significantly through 2026, with some models suggesting default rates could reach levels not seen since the aftermath of the 2008 financial crisis. But the mortgage time bomb isn't detonating in isolation. Another critical warning sign is flashing red: the dramatic change in who's buying, and more importantly, who's selling in London's property market. For decades, international capital has been the foundation of London's property market, particularly at the higher end. Russian oligarchs, Middle Eastern royalty, Chinese entrepreneurs, and European financiers poured billions of pounds into London real estate, treating luxury properties as safe deposit boxes in the sky. This foreign investment was so substantial that by 2015, non-resident buyers accounted for over 60% of all prime central London purchases. Areas like Kensington, Mayfair, and Belgravia became global showcases of wealth, with some streets containing more empty investment properties than actual homes. Today, that picture has dramatically changed. Data from major estate agencies reveals that foreign buyer participation in London's prime market has plummeted by nearly 50% since its peak. The most striking example is 60 Curzon Street in Mayfair, once marketed as London's most exclusive address, which still has half its apartments unsold nearly a decade after launch, despite an insolvency and multiple price reductions. This international retreat from London property isn't random. It's being driven by specific policy changes and global shifts that serve as clear warning signs for the broader market. The most significant factor is the elimination of the non-dorm tax status that made London so attractive to the ultra-wealthy. Under this regime, individuals could live in the UK while avoiding tax on their worldwide income. Its removal has prompted thousands of high-net-worth individuals to relocate to alternative tax havens like Dubai, Monaco, or Singapore. Geopolitical factors have amplified this trend. Russian oligarchs face sanctions, Chinese investors face capital controls from their government, and Middle Eastern wealth is increasingly flowing to other global cities with more favorable tax treatment and fewer regulatory hurdles. The impact on property values has been dramatic, but largely concealed from public view. In neighborhoods like Mayfair, Belgravia, and Knightsbridge, property values have fallen by over 20% from their peak when measured in pounds. For foreign buyers who also face currency fluctuations, the decline is even steeper, often exceeding 30% when measured in dollars or euros. What makes this exodus particularly concerning is how it exposes London's luxury oversupply. Developments conceived and financed during the 2010 to 2015 boom years delivered thousands of high-end apartments that now sit vacant or sell at steep discounts. This inventory overhang creates downward pressure on the entire market. The withdrawal of international capital matters far beyond the concerns of the super rich. London's luxury property market was the engine that drove development across the city, subsidizing affordable housing through planning gain and generating billions in stamp duty that funded government spending. As this market collapses, the entire economic model of London property development is called into question. Without premium sales to support the economics, developers are pausing projects, reducing affordable housing contributions, or pivoting to entirely different property types. This isn't just about luxury properties anymore. The contagion is beginning to spread to the broader market as another key player starts heading for the exits, the landlords who own nearly 1/3 of London's housing stock. A seismic shift is underway in London's rental market that few are talking about. Landlords are leaving in unprecedented numbers, creating market distortions that point to a coming crash. Recent data from the National Residential Landlords Association shows that 19% of London landlords sold properties in the past year, while only 8% made new purchases. That's a net reduction in rental stock at precisely the time when demand is soaring, a divergence that might seem counterintuitive but actually signals a market nearing its breaking point. Even more telling, 41% of remaining landlords report plans to reduce their portfolios or exit entirely within the next 2 years. If this happens, tens of thousands more rental properties will disappear from the market by 2026. Why this mass exodus? It's not just one factor, but a perfect storm of challenges that experienced property investors recognize as warning signs. First, mortgage costs have doubled for landlords, transforming once profitable investments into cash flow negative properties. Buy-to-let investors, who expanded aggressively during the era of 2% interest rates, now face negative returns after financing costs. Even raising rents, which have already hit record highs across London, cannot close this gap in many cases. Second, regulatory changes have dramatically altered the risk-reward equation. The Renters Reform Bill scrapped Section 21 no-fault evictions, which allowed landlords to regain possession of properties relatively easily. While providing important protections for tenants from a landlord's perspective, this adds significant risk and complexity to property management. Third, tax changes have steadily eroded profitability. The phasing out of mortgage interest tax relief, the 3% stamp duty surcharge on additional properties, and the elimination of various tax advantages for landlords have combined to make property investment far less attractive than it once was. The consequences for London's property market are severe and contradictory. As rental supply shrinks, rents are pushed higher, creating the illusion of a healthy market. Yet simultaneously, former rental properties flooding the sales market add to the supply glut, putting downward pressure on house prices. This creates a dangerous divergence between rental yields, which appear strong, and capital values, which face increasing pressure. Such divergence is a classic pre-crash indicator that appeared before both the 1989 and 2008 property crashes. For professional investors, the math simply doesn't work anymore. The traditional calculation for property investment, where rental income covers mortgage costs with a margin of safety, has broken down. Even properties generating gross yields of 5 to 6% can produce negative cash flow after financing, taxes, and maintenance. What's particularly alarming is how this landlord exodus mirrors patterns seen just before previous market crashes. In both 1988 and 2007, there was a similar wave of experienced investors exiting the market, while amateur investors, fueled by FOMO, fear of missing out, continue to buy at peak prices. This transfer of properties from experienced hands to less knowledgeable owners is a classic late cycle warning sign. It represents a shift from investment based on fundamentals to speculation based on hope, a shift that historically precedes major market corrections. So, the warning signs pointing to a 2026 London property crash are multiple, interconnected, and increasingly difficult to ignore. The 18-year property cycle that correctly predicted previous crashes is now signaling another downturn. The mortgage time bomb of expiring fixed rates threatens hundreds of thousands of homeowners. Foreign buyers and experienced landlords are quietly exiting the market, affordability metrics have reached mathematically unsustainable levels, and sophisticated investors are already repositioning their portfolios in anticipation. This convergence of warning signals doesn't guarantee a crash, but it significantly increases the probability. More importantly, it demands prudent preparation regardless of whether the correction is severe or mild. For existing London homeowners, now is the time for financial fortification. If you have a mortgage coming up for renewal in the next 12 to 24 months, consider refinancing early, even if it means paying a small penalty. The certainty of a secured rate may outweigh the cost, particularly if market conditions deteriorate. Build emergency reserves that could cover at least 6 months of mortgage payments and essential expenses. And honestly, assess whether your current property would remain affordable if your income decreased or interest rates rose further. For potential buyers, patience may be the wisest strategy. While timing the absolute bottom of a market is nearly impossible, avoiding the likely peak before a correction is a more achievable goal. If you must buy in the current market, prioritize properties with intrinsic value that will hold up even in a downturn. Good locations, solid construction, efficient layouts, and versatile spaces. And consider negotiating aggressively, as growing inventory levels are already shifting leverage toward buyers in many London submarkets. For investors, this environment demands extreme selectivity. The blanket assumption that any London property is a good long-term investment no longer holds. Focus on assets with strong cash flow that can weather a downturn, even if their appreciation potential seems limited in the near term. Consider diversifying geographically, both within the UK and internationally, and maintain liquidity to capitalize on the opportunities that inevitably emerge when markets correct. For everyone involved in London property, perspective is essential. Real estate cycles have existed for centuries and will continue long into the future. The coming correction, whether mild or severe, is not the end of the story, but merely another chapter in London's property market. Those who panic will make poor decisions. Those who deny the warning signs may face financial hardship, but those who prepare thoughtfully, who understand the risks but also recognize the eventual opportunities, will navigate this challenging period successfully. London has reinvented itself countless times throughout history. Its property market has experienced booms and busts, yet the fundamental appeal of this global city remains. The warning signs suggest challenging times ahead, but for the informed and the prepared, even property market crashes present possibilities for future prosperity. The choice now is whether to heed these warning signs or ignore them, and that choice may determine your financial trajectory for the next decade.